Hi, everyone. This is Omar Khan, the founder of Boardwalk Wealth.
Hey, Sean Corbett here, marketing for Boardwalk Wealth, and we're just going to kind of jump right into our 2020 roundup for the year. So, Omar, I know there's a lot to talk to you about, and obviously this year's been pretty dominated by COVID talk. So, I don't want to dwell on it too long, but just to do a little brief wrap up, I thought we would maybe chat about what you thought would happen at the start of the year versus what actually happened, and possibly touch on the topics of debt, property valuation, distributions, and resident management. Sort of with COVID as the overarching topic.
Well, start of the year was very nice. We were coming from a really nice 2019. I did not know I was going to enter the longest year of my life. Start of the year was really good. We actually had a couple of deals, best and final, right about to put them under contract. And that's the week in March when COVID, it hit earlier, but that's when it really took over. I remember I was in Atlanta. So kind of nixed those deals. And again, as you all know, that the first couple of months, we're all trying to figure out what's going on. Nobody really knows. We're all really panicking. Is this that recession everybody kept talking about, right? Like everybody saying for the past, oh God knows how many years, we're in the ninth innings, or we're in the bottom of the ninth, or the top of the ninth, or some version of the ninth innings. And this is when the music stops. So everybody's now thinking that. And what we saw was that if you cut through the noise, there was no discernible effect. Touch wood so far, right? So what had basically happened is our tenants were paying on time, thankfully for us. That speaks, by the way, to our acquisition criteria, because we're only buying in good neighborhoods with good demographics. Because I know for a fact, a lot of guys got killed basically because they bought in areas with lower income, lots of deferred maintenance. There was lots of issues with their tenant profile, and they just didn't tenant it properly. So they got crushed. But on our portfolio across the board, our collections were 95, 99% plus, give or take. We're actually pre-leased right now at 99% on one property, and another set of properties were about 95 to 97%. To give you an idea. Debt-wise, what had happened is what basically I had been saying all along, that look, once you get into this spiral of low interest rates being the solution to every problem in the government's life, the rates aren't going to materially rise anytime soon. And that's why we had positioned our portfolio to have floating rate debt. And we really took a lot of advantage of that, the flexibility, let alone anything else. And a lot of guys who say didn't buy the right asset, then stupidly put like fixed rate debt on it. And then on top of that, rates went down by 100 basis points. Now they're stuck in limbo. Their prepayment penalties are very high, so they can't get out of the deal, if at all. And on top of that, their tenants aren't paying any money because they just don't have money. So bad structure, bad financing structure, bad deal details crushed a lot of guys in that space. In our particular case, what had happened is we knew that even if, God forbid, if we were ever in a situation where the residents were having difficulty because we acquired in good areas and our financing structure was very flexible and open with no prepayment penalties, we could always liquidate without taking a haircut or a massive haircut. So that really helped us and helped us go to sleep at night. Now, with regards to valuation, what happened is there is and has been a lull in deal activity or deals getting done versus last year, 2019. But a lot of deals have been done. We're basically closing one in Atlanta. It's the only deal of the year. And the reason for that is because we just didn't feel comfortable investing our money when so much uncertainty was there. A lot of times you want to move, but you also want to be good stewards of people's capital. So you don't want to just, be swashbuckling. This is not the time to be swashbuckling. Then with regards to valuation, what's happened is in some cases, they've stayed sideways. We're talking about these assets where, for instance, the rate of interest has gone down. So new person coming in should be able to acquire it at a very attractive interest rate, but the seller can't even sell the asset because they've got either a big prepayment penalty or the asset has such massive, say, bad debt, vacancy issues and all of that stuff, that the price that the market will pay is just not worth it for the seller to sell. And they're like, look, we can just kick the can down the road and try to figure it out. So a lot of those deals haven't been done. Now, a lot of B plus type deals, their activity has started picking up, especially in Q4. And it's been strong primarily because the cost of servicing your debt is so low. The fundamentals of multifamily continue to be so strong. And more than anything else, a lot of target dated, time dated funds that were, say, in the hospitality sector, the retail sector, the office sector, with so much uncertainty there, they decided to move their funds into multifamily just because it's such a recession resistant, strong asset class. So for the right assets, valuations have have gone up or creeped up a little bit. For the wrong assets, valuations have gone down, like we've always said. And with regards to distributions, what's happened is, look, we didn't stop any distributions because, like I said, look, it was business as usual. So far, it's business as usual. If you didn't know that the pandemic was happening, if you're living in a cave, you would think this is just another day. This was just like 2019 or better in a lot of cases. But I do know that a lot of sponsors decided to cut distributions, some for legitimate reasons, which I can understand. But a lot of guys who were not well capitalized, they used COVID as an excuse to cut distributions because they weren't performing well pre-COVID. So they're like, let's use this as an excuse, cut distributions, and again, we'll kick this can down the road. So you always have to look at these things on a case-by-case basis.
Got it. Now let's talk about return numbers. And the reason why I bring that up is because I feel like people often will freeze a metric from when they started paying attention to it first. Then they assume that metric or the result is normal and it should stay the same forever. So tell us what you see as being a realistic return bracket for cash on cash and IRR for 2021. Let's assume a typical B-class value add deal in, say, a metro with a 1 to 8 million population range.
Okay, so in that particular case, if it's the type of profile of assets that we've been buying, return expectations have gone down a little bit. Again, that's purely because of cost of financing is very low. So that's attracting a lot of newbie sponsors and just experienced sponsors to just overpay. But also, as I mentioned, a lot of these target dated funds in hospitality, retail, and office are moving their funds over to multifamily. So that's causing some competition. So one has to be very picky. We're targeting what we're looking at right now. Our returns net, and these are net of all the fees going to investors, net of all fees, anywhere in the 13 to 16% IRR range, about 7 to 8% cash on cash, give or take. Again, this is an average. Some are up, some are down. So you always want to make sure that, again, you look at deals on a case-by-case basis. But these just apply to our particular type of niche, B plus type locations, strong demographics, strong school districts, and about $55,000, $70,000 median income, give or take.
What were the numbers for cash on cash and IRR?
Oh, so sorry, the numbers are mid-teens IRR, so about 13 to 16% for IRR. Again, this is net of all fees, right? And cash on cash, 7 to 8%.
Got it. So that's what people should expect realistically 2021.
Yeah, look, there's always financial engineering. I have this conversation multiple times a week. In fact, Sean knows this, that some sponsors will show you a really high IRR. And people are like, well, he's getting 20%. And yeah, because he or she's assuming things that, once you actually dig through, their projections aren't an actual reflection of reality. But we're talking, you're not taking any shortcuts. You're doing the right thing at the right time, at the right pace and intensity, in the right submarket with the right asset.
Absolutely. Now, you did mention this earlier. We're closing a deal in Atlanta as we speak. So I was hoping you could tell us just about some of the deals you passed on this year and why, some you bid on and lost and why, and maybe just kind of wrap it up in the context of this recent Brighton Farms deal.
So look, in the context of this recent Brighton Farms deal, we already knew the submarket because we already have Equinox at Night, or the sister asset, about 30, 35 minutes away. So we already know the demographics. We kind of know the school districts, what type of employment drivers there exist. So we were always interested in this little corridor, from Fayetteville, Peachtree City, and Newnan. And Brighton Farms is in Newnan, and Equinox at Night is in Fayetteville. So this is a very affluent little corridor on the south of the Atlanta MSA. Now, with regards to a lot of deals that we passed, a lot of times, some of the competition at the start or around the mid of the year basically was from a lot of guys, again, who had target-dated funds in hospitality, retail, and office. They obviously were having a hard time investing in those sectors or convincing their investors to invest in those sectors just because of the carnage that was happening and was expected and is expected to happen, right? So, but they still had that dry powder that they could go invest. So they just had to move into multifamily because they want to invest it somewhere. Good example is an asset that was recently traded in Newnan, actually, and our property manager was actually taking over that asset. And the whole reason why the sponsor bought that asset was because they had already raised money from investors. And that was for, I think, retail and hospitality. And the flip side was if they couldn't invest in a retail and hospitality by year end, then they'd have to return those funds back to investors. And they didn't really want to do that. So what they did is they came to a multifamily, bought a 2000 vintage property and paid like $30,000 or $40,000 a unit extra on it, even though their numbers are not penciling out, because their theory was, well, number one, we get to invest it, so we get to take the fees and all of that. And it can't be worse than hospitality, which you can make of it what you want to make of it, but that was the rationale. So that was around the middle to about, say, September of the year. The other deal also is because interest rates have gone down so much. So a lot of people who were on the sidelines are now more and more interested in coming in, especially if they can acquire properties on a free and clear basis. Again, a lot of them are still doing the same, running into the same problems that sponsors earlier were getting into, that they get these fixed rate debts, but they want fixed rate debt, but they want to get out in 2 or 3 years. So yeah, they feel really nice acquiring it right now, but in 2 or 3 years, they're going to be back to the exact same spot. So those were the two biggest sorts of competitors for the reasons why we passed on properties. The third biggest reason was, I mean, I looked at those properties, to be honest with you, I didn't really bid too much because I just wasn't interested in that demographic and income profile. But a lot of those properties, as we mentioned, that are really stressed because of the unfortunate economic things that have occurred in the economy. Those types of tenants or residents in, say, C minus type properties that have lost their jobs, their bad debt is like 15, 20, 30% in a month on the property. Their economic vacancy is 30, 40%. Even if those sponsors want to get out, they don't want to take a haircut on the valuation. And I wasn't really interested in it, but that's the third little bucket of deals that there's a lot of those deals in the market. You just don't want to touch them.
Fair enough. Now, this next thing is not really a question. It's more of just giving some context to our audience, and then I'm going to get your thoughts on it. So we do use the phrase ultra conservative a lot. We describe ourselves as an ultra conservative company, and we do ultra conservative deals. When we do that, we're not trying to make some comparison to Edmund Burke or anything like that. We're just basically saying we excessively err on the side of caution on behalf of our investors. We take into account the most broad application of the law, stuff like that. And I have noticed that sometimes it causes friction for people. And in fact, frankly, it causes friction for us too on our end. So we kind of got, if somebody's listening and they feel like excessive ultra conservatism is going to cause friction for me, then yeah, we're probably not a good fit for you. It's time to cut bait. But anyway, I just wanted to basically summarize, so it stays anonymous, an email we got about our verification process on the latest deal. And then I'll get your thoughts on it here, Omar. So this fellow wrote to us that it could be you're right and everybody else doesn't have the appropriate level of compliance. I think you could be right, but your interpretation of Fed requirements is super conservative and will cost you. You're definitely at a disadvantage compared to other sponsors, but I guess who cares if you have enough sponsors that are willing to do it? Or pardon me, willing to have enough investors that are willing to do it. So he sort of made both arguments for us there, Omar, but I wanted to get your thoughts on that.
Look, in the context of, just to give you context, what had happened is in our deals, when we're doing a 5 or 6C offering, we can only cater to accredited investors, and to those accredited investors, they have to provide us some form of an accreditation letter. Now, we pay our investors. We say, look, if you don't have a CPA or your CPA, lawyer, investment advisor, stockbroker can't, won't, or doesn't want to do it, don't worry. We will pay for it for you to go to a third-party website. It's Verify Investor in that case, and they'll do it for you, and we'll pay for it. So you don't have to worry about it. There's no cost attached to it for you. But we do need that letter because that is a requirement of the law, and I'm not going to break the law. So in the context of this thing, what had happened is this gentleman was basically saying that, and he did end up investing. His problem was that we were requiring an accreditation form for him, and he just said, "Well, why don't you take me at my word?" And I said, "Well, look, I think you're a nice guy. I know you're a nice. I hope you're a nice guy. But when I have to run a compliance in my firm, I can't just go off a hope and a prayer. So there are a certain amount of steps we have to follow. And if this means we lose some investors along the way, I mean, that sucks, but that's just reality, because we have to ensure that all the I's are dotted and the T's are crossed." And this person seemed to have a huge issue with this. And he said, "Look, you're going to lose a lot of investors. Other sponsors don't do this." And my answer to this was, I get it, but I'm not other sponsors and I'm not responsible for what they do. I'm responsible for my actions and the actions of my company. So the idea, what we wanted to explain, what I wanted to say was, look, this is not a me thing. The more friction there is created in a deal, if you think about it, the worse it is for a sponsor like me, because I am in the business of managing money, right? So I don't want to have more friction, but we're not going to relax our compliance standards just because somebody seems to be having a bad day and does not agree with the law. If you don't agree with the law, please go change the law. I'm just not going to go break it.
Yeah, and I think there's a greater point to be made there too, which is that this carries over. It's not just about
Yeah, it carries
verification and
over to multiple
compliance.
things in your
Yeah,
business, right? When you skip on one thing, trust me, any sponsor who says, yeah, don't really worry about it, the law says this, but don't worry, we'll cut some corners here. Don't worry about it. I know you're a nice guy.
I think that shows somebody how they're also managing the deal, how maybe they're
Yeah,
running their operations, how they're looking at their numbers on their properties. I think it reflects on the whole thing.
because how you do one thing is how you do everything, right? So when it should, for you as an investor, raise alarm bells if somebody says, yeah, don't worry about it. Don't worry about it. It's a law, but we don't got to follow it, right? Don't do that. It's for your own benefit. There is a reason why these laws exist. We don't have to agree with the laws. Frankly, it causes a lot more paperwork for me because I've got to track everything. We have a whole team that does it, a back office that does it. But when a sponsor is following the law, they have a good, I mean, it's acceptable level of compliance, and they're dotting their I's, crossing their T's. The sponsor is meticulous. They have your best interests in heart because they're not going to go take shortcuts. And how you do one thing is how you do everything. So when you take a shortcut in one area of life, there's a very good chance that sponsor is going to take a shortcut in multiple areas of your business. And that's not the kind of person or company you should be investing your money with.
Yeah, agreed. So often our messaging as a company can be quite blunt, it's to the point. Sometimes that's interpreted as cynical. So I just wondered, let's end the year on a
Yeah.
good note, on a rosy, positive note. I wanted to ask you if you had any sort of uplifting or at least exciting outlooks for Q1, Q2, 2021.
Oh, I'm very excited. Number one, regardless of what you believe, look, a vaccine is here. So, regardless of whether you want it or you don't, that depends on you. The market sentiment is becoming more positive because people see light at the end of the tunnel. What does that mean for us as sponsors and for you as investors? What this means is deal flow should increase, number one. Number two, what's going to happen is a lot of sponsors who even got right assets but didn't capitalize them the right way, there's only so much of they can kick down the road. Because eventually, if you take shortcuts, you don't do the right things, you've got to pay for it. So a lot more deals are now potentially, there's a probability of them being available Q1, Q2, Q3 of 2021. Whereas in 2020, a lot of people were saying, look, let's just try to wait it out. Let's try to wait it out. And the smart ones waited it out, but they were capitalized correctly. But the people who took shortcuts who weren't capitalized correctly, time has started running out on them. Most of those guys' time has run out. So when you work with the right people, what you're going to see is a lot better quality and better deal flow coming up in the coming year. But as always, one has to be extremely careful, vet the right deals, right sponsors, have the right level of expertise to even deal with these situations. And that's what I'm really excited about. We've also got a couple of other surprises that we're going to share with our list soon. And if you have any questions, please reach out to me.
Oh, awesome. Omar, I appreciate you doing this, and everybody listening and watching. We really appreciate your time and your trust and, doing business with Boardwalk Wealth in 2020. And like Omar said, we do have some interesting and exciting things coming down the pipe for more engagement and to let you even see more behind the scenes of some of our processes.
Thank you.